Joining us right now is Pacer ETFs President Sean O'Hara. Sean, it's great to see you.
Nice to have you.
Have higher rates, and we're seeing this creep up, and today it's a pretty big move. Is that impacting investors?
I think it's potentially a good thing for equity markets if you think about it. There's been a lot of discussion all year about the yield curve and how flat it is, or maybe it's going to invert, and then that generally is a precursor for a recession. Earlier this year, as the 10-year poked above 3%, foreign buyers would come in and drive the yields back down. They used to be able to hedge their currency away in a fairly inexpensive way. Now those hedge costs have blown out, and so those buyers aren't there, and that's letting the 10-year drift a little higher than it might normally, which is actually making the yield curve a little steeper, which may be in the long run a good thing for equities.
Long run, but over the short term, I mean, people are looking at equities versus treasuries and saying, well, I get more safety and a better yield here. Isn't that the reason that markets get unnerved?
It could be, but
as rates go up.
You look at what the market's done, and you look at the underlying economic fundamentals to the market right now. I don't think people are going to say, "Let me sell my growth portfolio and move into treasuries," because the yield has gone from 3 to 3.2.
Because it's still really low.
Very low still, historically speaking, and in absolute terms. And you get more bang for your buck in the equities markets right now.
So is there a line in the sand for you when you think about the 10-year treasury? Because I've heard, 3.25%, 3.5% is where it's really going to impact negatively the equity markets.
Well, I don't know that it's 3.25 or 3.5. I mean, those would still be historically very low rates,
right.
And I think the real precursor for what's going to happen to equities is whether or not the economy continues to sizzle like it is, and whether earnings continue to sizzle like they have. What will be interesting to see is next year as we get our comparables, because this quarter, first quarter, second quarter so far, have been huge growth in earnings, but those numbers are going to be relative next year because we're going to have to see whether or not we can continue to see that kind of growth. The most fascinating thing to me about looking at this market is that there's real opportunities in this market in two areas. One is international, and it's been very hard to invest there. And so we've got a couple of international ETFs. But the other thing that's really fascinating is value, and in particular, large cap value has underperformed growth for almost a decade. And historically, value does better than growth over time. So sooner or later, that trend will change. And so if you're concerned about equity valuations and you wanted to reposition your portfolio today, and you don't want to go international or emerging markets because it's pretty dicey, one place to go to at least position the portfolio differently is to go to large cap U.S. value.
Mm-hmm. You talk about sizzling, though. We are sizzling. I mean, we are now in the fourth quarter, beginning of the third quarter reporting season. You've said it 100 times. We're looking at growth in profits of 22%.
It's come down to 21.4, but
21.4.
Still, it's
profit growth.
In a row.
What are you talking about? Revenue growth. What's revenue growth?
Revenue growth is 8.2% for the quarter. Last quarter we had 10% sales growth. That's the first time in many, many years.
But this is end market demand. We got the jobs number out tomorrow, Mike. What are you looking for? We're talking about another triple-digit move. Yesterday we had the ADP, 230,000 jobs created.
Absolutely, and I think the reason the market's so resilient here, Maria, is that we kind of see the trajectory there. I don't expect any surprise in the jobs number. It's a very strong economy. People need to go out and pay more money. Even Amazon raised earnings, wages for their workers. So we're in a very strong place right now, and that's going to continue for the foreseeable future. So as long as it does, the equities market is a good place to be.
Sean, all of those things are true, yet you still hear naysayers and critics say, but the trade, but the stare down, but the tariffs. Your thoughts on that environment and how it affects the broader market?
I wouldn't bet against the guy. If you look at what's happened, he put a great plan together to get Mexico and Canada and redo NAFTA. He's working with Europe. And I think the long-term plan has always been to build a coalition against China. And when that happens, I think ultimately, if I was a betting man, I'd be betting that China will balk first. I mean, they're in far worse shape than we are. Our markets are strong. Our economy is strong. And I think sooner or later, the pressure is going to be so much that eventually they're going to have to give a little. They're at an advantage, I guess, in that they've got a lifetime president, so he doesn't have an election. And usually what they would do is try to wait out the cycle. Mm-hmm. But he's putting a lot of pressure on right now. And I think he's given them a little bit of room. He doesn't want, perfection. He just wants it to be better and more fair than it was. And the wild card in all of this is if we can get China to help us with North Korea.
Yeah, I think markets understand this.
Yeah, I think so, too.
Investors are giving him the benefit of the doubt. Sean, it's great to see you.
Thank you so much.
Thank you so much. Sean O'Hara from Pacer ETFs.